Pratik Agarwal, CIO at ASK Investment Managers, is joining us on the show right now. Pratik, good morning to you. I mean, we're starting off the new year on a slightly positive note, no big bang moves. But what is the anticipation as we step into 2019 and the factors that you are anticipating in terms of volatility, global cues, our own domestic cues that will play out for the Indian equity markets?
Yeah, so beginning of the year, we are actually looking at more number of issues than I remember having looked at any other beginning of the year. So we start the year looking at U.S. China trade spat. We are looking at tapering continuing in the U.S. and more geographies, including the Eurozone, to commence to tapering as we go deeper into the year. We are looking at elections in the Indian context and so on. So the number of issues that the markets will have to take care of during the year are significantly higher than the usual. And that said, while the valuations do seem to be more defendable than where they were last year, but overall we still believe they are at the higher end, and the overall compounding that one should expect from the equity market would be a tad lower than the earnings compounding, so that some amount of valuation correction takes place. So those would be our thoughts. Overall, in terms of growth, global growth should be a tad lower than what we saw last year. US, the biggest economy, is close to full employment. So versus last year, very difficult to build a case of encore. It will be lower. China is already slowing. So the two largest engines of global growth are definitely slowing. So with that, if you build the outlook for commodities, one should expect this to be a softer commodity year versus last year, and which by extension then means that in the Indian marketplace, businesses which are users of commodity and have pricing power, so branded businesses, cars, etc., would have some amount of margin uptake, possible margin uptake. And then, if we try and build a theme as to where we are or we would want to be focused, then, the space where we have a margin uptake, if we can complement it with strong growth in volumes, I think that is the space that would stand out. It would be a narrow space. Most of the names would lie in the consumption basket, given that capex would not happen, simply because any company that corporate banks would be happy to lend are not actually doing a capex, they're simply acquiring somebody else. And government is focusing on loan waivers, etc. So focus on capex will actually reduce, which then leaves you with a consumption play and financiers of consumption as being the main drivers. That is the space, frankly, where we are focused and we believe would sustain in a dicey marketplace that we foresee over the next year.
Pratik, good morning. Neeraj here. Happy New Year to you. And if that is indeed the thesis, then you should be a happy man, because I think some of those plays have fallen maybe slightly out of favor of the mainstream market and are available at more reasonable valuations than what they were maybe 6 months ago.
Yes, some of the names have done that, and that gives a good entry point in some of these names, yes.
Okay, interesting. The question mark though is why the belief of these companies doing much better than the rest of the market, wherein I hear a lot of people talking about how the capex revival or signs of it might bring about a change in the fortunes of, say, the capital good companies, for example, and it might be an area of reckoning for them, or maybe corporate facing banks, because while they haven't done too much in the recent past, the earnings recovery and the resolution of doubtful assets might bring about better numbers for them, and therefore the market might give them a higher preference than the favorites of 2017 and 2018.
Yeah, sure. So, one, if you look at a news item that appeared a few days back, it actually pointed to new project starts, which is what a capex company would focus on, to be 14-year low. Okay, let that sink in. So, capex is not happening. What are the three large spaces where capex happens? Steel, power, maybe cement, right? Now, steel and power, the companies which are still interested in this space and to whom banks will still be okay to lend, are acquiring stressed assets. They are not creating new assets. Generally speaking, and so also in cement. So, yes, capacity utilizations are moving up, etc. But as yet, we don't see a big move in capex happening on the ground by Indian corporates in the listed space. Yes, some bit of capex is happening from foreigners, so FDI is high, and that some part of it may be new capex, but most of that is also purchase of already established businesses, be it Flipkart, be it real estate, etc. If you look at corporate banks, yes, they will have or they should have a earnings uptick, because the provisioning requirements going forward would be lower than what we have seen in the past, and in fact there may be some write-backs. However, their growth is also coming from retail rather than corporate. In fact, today's newspaper itself covers what an ICICI bank would do going forward, and it clearly says that they want to focus on retail versus doing capex lending. So that is what it is. Yes, last quarter saw a lot of capex oriented businesses deliver very good numbers, but our conviction in the sustainability of the same is pretty low at this point in time.
Prateek, just want to get your sense in, when the IL&FS crisis happened, we saw the impact of that on all of the NBFCs. Do you feel that the full impact of that has been already felt in sectors like construction, housing, the small and medium enterprises, autos, or there is still some more left to go, and that could keep continuing till probably even mid-year or even in the second half?
So, even I would want to wait and watch. December was a terrible month across the board for, let's say, auto sales, a part of the market which was seen as a bellwether, pulling up hopes, pulling up the economy, etc. A few things happened in December. One, it is end of the year, so inventory cleaning happens, and companies which may have had a higher degree of inventories delivered lower numbers. Because the numbers we see are factory numbers, they are not what gets sold at the end channel at the showrooms. So that is one. Second, financing was less available. So if your vehicle is sold mostly in the cities, then you are less impacted versus if you were sold more in the smaller towns and villages. So that was the second thing. And third, this is end of the year model change period, and companies give discounts. So some companies which may have delivered better sales numbers may have given larger discounts as well, and vice versa. So, but that was a December effect. Now, if the same thing persists in January, then I think we have an issue at our hands. Some bit of demand impact, especially in cars, should be expected. Cities account for a large percentage of cars sold. We all know that, as you get space to drive, as highways get constructed, more number of cars get sold. But in cities, there is no place to drive. All cities without exception, and you find increasingly that even people who have cars take public transport to work and back. So, deferment of decision making in automobiles is, I would say, almost definitely happening, anecdotally speaking. And but yes, we need to quantify the impact. And like I said, if the slowdown persists in the month of January, then there would be a concern building up there.
My final question, and that is on real estate. It's not a meaningful part of the market, but do you reckon 2019 could be a year of portfolios having real estate in their stride, because the numbers for some of the larger players and the higher quality players might start showing big time?
We have stayed away from real estate for a very long period of time, and I guess we would continue to do so. One or two investable names in each marketplace, I would believe, Delhi, Bombay, Bangalore. But that said, house sale intensity is not really increasing. If you look at the Bombay market, you are getting good discounts if you want to buy. So that is also happening. And the other thing that is happening is people postponing purchases to, when they see the building ready and they don't have to pay GST in an OC obtained building. It makes so much more sense to wait out for the project to get completed rather than to be buying when it gets launched. That changes the complexion of the game from being a very high ROC business, the house construction part. It is becoming a very, very average ROC business, and this is without taking the purchase of land or the over purchase of land that most developers have done. So I think we need to bake in the numbers. It's still time. It is still evolving. The big hope that was there in the real estate space was consolidation. Anybody who does not have a brand was just not able to sell anything at all. And hence, we are seeing move from, lesser brands, no brands, to larger, more credible brands. But larger, more credible brands are very few. They are having their pick, and the consolidation is significantly slower than what one would have expected. So, yes, a trend, it will play out over a period of time, but I think it is going way slower than what people expected.
Okay, let's hope it quickens up, but Pratik, of course, wants to stay away from there. And interestingly, he's still sticking to his favorites that he had spoken to us on Alpha Muggles a few months back, which is consumers and consumer financing related companies as well. Pratik Agrawal, take a moment to thank you for joining in today and giving us your thoughts, and wish you and your team a great 2019.